volatility, a very different figure from other measures of volatility, because it is speaking about the potential of this market to move, right? We will dwell on this idea more and more and understand what we mean here by potential and how to capture that potential, which is the center idea of this monthly webinar, is to build the foundations for our trading model based on this concept of coastline, and based on a concept that the time is differently understood as in a normal chart configuration or a conventional chart configuration. Okay. So far, is everything understood? Are there some doubts, some questions? We will have quite a long webinar. It's being a monthly webinar. It would be good to have some sort of interaction, and we will have time to discuss everything in detail. Okay, if there are no questions, I go ahead. I move on. This is I want to mention here the sources, the conceptual sources I've based this this research. I'm constructing here on the shoulders of others who have obviously done a much deeper investigation into the field of price action, of price behavior. One of the sources is Mr. Richard Olsen from Olsen Limited, in collaboration with the Center for Computational Finance and Economic Agents from the University of Essex. There is a material that has been very useful in understanding the concept of coastline and the potential in terms of price movement. Here we have a table where I've highlighted here under the euro-dollar column, and corresponding to the threshold line 0.05%. What does this mean? Is that if we measure the coastline as we have measured with a pointed figure chart in thresholds of 0.05%, then we would get a coastline in percentage terms of 2,311.6 in euro-dollar and on a yearly basis. Okay, so 1 year of euro-dollar price movement would have the potential for more than 2,000%. Euro-dollar at 112, around 112, this would be more or less a 6 pip threshold. As we said before, if we go down into smaller thresholds, then the coastline becomes larger. If we measure the coast, or if we take the threshold of 1%, for example, would be around 120, 130 pips, 140 maybe today, and so forth. The bottom row on this table, 3.2 threshold, 3.2%. Those would be movements of 380 pips. Okay, movements of 380 pips in a row without a counter movement of the same amount. Okay, and then we have the potential percentage, the potential percentage coastline that a market can move in 1 year. Okay. The question here is, can I capture from all this percentage? Can I capture, for example, a 3% of 2,311? Can I capture only 3% from this? In that case, 3% from 2,300 would be around a 10% annualized without leverage, without applied costs here. But we see that trying to capture a very small amount, a very small percentage of a big coastline is already, in terms of unleveraged results, is already a quite good percentage. So in a year, 10% in a year, I could get those 10% only by trying to capture 3% of all the price movements in the euro dollar when measuring in 0.05 thresholds. Okay, so as you see, we are not trying here to go for higher and two-digit numbers, like trying to do 15% from a market that only moves 20 or 25 a year, taking the volatility as an absolute range from high to low in the year. But we are speaking of capturing a very small portion of a very large movement, And when I formulated this question, or when I heard this question being formulated, it was rather so, something captured my interest, obviously, because here we are speaking of a much more realistic approach in the number of potential which is being offered by a market, and the humble projections that you might capture.